Asset Management During an Era of Populism, Trade Wars, and Negative Yielding Debt. We are very pleased to have Frances Newton Stacy, Director of Portfolio Strategy for Optimal Capital, as our guest. Ira Atkinson of Mirae Asset Securities, a moderator. Before we launch into this very exciting session, and I should add that both B.J. Belloc and myself were able to hear Frances speak recently at the British Consulate in New York, and we thought that she had some really interesting insights into both current market conditions and what shapes change, and the extent to which impact on the future. But before I do that, before I introduce Frances, I do want to acknowledge and thank our sponsors, without whom this would not be possible. These sponsors include Alston Bird, Bay, Bloomberg, Deloitte, and Thornton, New Capital, and the Association. So, let's launch into this. Frances, good morning to you. You're speaking to us from Denver, Colorado.
Actually, the West Coast.
Oh, so you're even further
No
behind.
problem.
Okay, so early morning. Well, actually, it's not early morning. It's 9 o'clock then for you. So again, welcome. We're very happy to have you. And I thought it might be very interesting to talk about your background first. So you can give us a little bit of bio information here, and talk a little bit about how your background has shaped your viewpoint regarding asset management and navigating the many variables that we are contending with today in the marketplace. So, Frances, take it away, please.
Absolutely. Good morning or afternoon to everyone, depending on what time zone you're in. Yeah, I have kind of an unusual background. I started day trading basically when I was in college, and I started day trading sort of, late 2006 and early 2007. I was studying your quintessential Great Depression charts, which every day trader 101 studies, and without all of the extraneous noise of a lot of other information. I very easily at the time, just as a beginner, noticed the correlations between the Great Depression, 1929, and the year 2007. I believed in what I saw so much that I sold all of my stocks in September of 2007 and did short the market in October of 2007. So I did fairly well during the credit crisis, as sort of having beginner's luck. But all of it had settled out. I had a radio. I was on the show for the Rush Radio Network, and I did call also the bottom in 2009. Again, just looking at the chart patterns from the Great Depression. So that's a very limited data set. However, I did know after coming out of that I was very, very lucky. And so I decided to delve into what really were the mechanics of the business cycle. I spent the next decade or so studying central banking history, central banking legislation, coinage legislation, all of these different things that sort of are the foundation of our monetary system and what causes the business cycle and what some of the classical opinions versus the modern opinions of the business cycle are. In 2017, I started to get kind of concerned. Most credit crises have in W shapes, and that's just completely mechanical. And the reason is because it's a debt-based monetary system, and we tend to paper over those things. And so we are now more levered than we were at the onset of the financial crisis. So then I started looking at it with now all of this knowledge. Now I'm licensed, I'm an allocator, I work on an investment committee that manages $1.5 billion. And, how I look at this basically top of the V sort of type scenario that has played out historically in massive business cycle rollovers, and look at it from my perspective now, rather than being a day trader, as an allocator and somebody who runs portfolios. So that's kind of my history, and that's sort of perspective.
Francis, well, if I may, just pick up on one of the points you made, or one of the observations that you conveyed, which was that you studied the from the Great Depression, stock market crash, and compared them with 2000 with the financial crisis, the most recent one. And to what extent is prologue when you look at charts and looking at charts with the idea in mind that you'd like to predicate the future?
Yeah, basically, with so many new things that are in our commonplace, right? We have high frequency trading, we have a lot of algorithmic trading, we have sort of the advent of some of the AI stuff that I think is becoming more prevalent. I compare all of these new ideas against old traditional technical analysis, right? Because technical analysis has just been around for a long time, so you just have a lot of data there. The thing is that I look for what's similar and what's a divergence. And certainly when you look at the Great Depression, you had market top out in 1929, and then it fell until 1932, and went straight up from 1932 to 1937. It did not make a new high. Very importantly, it did not take out the 29 high. You had, we can go through the individual legs of this, but you had, something again in 1937. All of that 5-year gain was completely deleted in a year. And so the W formation, you had sort of the top of the part of it in 29. It went to 32. You had sort of the middle of the W in 1937. 1938, you lost that 5-year gain. Importantly, it made a higher low than 1932. And you had sort of World War II, which got us back on track for that final leg of the W and the manufacturing that occurred at that time. But it's also important to note that you did not get back to your 1929 high until 1951. So when we think of over the decades and we think retirement and buying and holding and all of these concepts that we have come to live by as investors, credit crises are a very important period because some of those old adages don't quite play out as we would imagine. Now, moving forward to today.
Francis, can I just interject and ask a question there?
Sure.
So the market index did not cover until the early 50s, you said. But what about a return basis? Weren't those companies forced to pay dividends to regain the confidence of investors? And
on the minute level, on the minute level, there were a lot of different legislative tools and different tightening and easing tools that went into play. But those things are sort of, anomalies for the time. If you go back to all of these different, iterations of credit crises, obviously you had different laws in play. If you go before 1929, you're going back before the Federal Reserve Act, right? But I'll say at a very high level, what's in common with all of these things is that you have, a boom cycle, which is a lot of credit released into the system. You have a tightening that occurs. In this case, central bank initiated tightening that occurs. You have a reduction in the overall money supply, and I'm talking about EMs because they're all extensions of credit on different levels, and an overall reduction in the money supply, and then you have what can have is an overcorrection on that tightening. And what you have is the money supply gets reduced to a point where it can't service the debt in the system. And have sort of a breakdown. You have a minor version of this in every recession. The credit crisis is something that happens not very often, and it is what happened both in the Great Depression and then again in the global financial crisis. It's when so many things are simultaneously over-levered. The reduction in money supply is so drastic that you have a multitude of credit events, not just a slowing of growth.
Okay. Very interesting. So let's talk about today and maybe shift gears for a second. Trade wars, et cetera, et cetera. How do you get the political uncertainty with regard to asset management Do you adjust your portfolio to compensate for this?
Just going back to looking at the charts from the Great Depression, where we had divergences from that W from the financial crisis, I first look at that. And notably, we have well taken out our 2007 high, right? So if we're overlapping that chart on the 1929 scenario, we have well surpassed that high, which is a divergence, as it made a lower high in 1937 at the top of the first V. Reasoning for that. So then I looked for the reasoning for that. Ben Bernanke, was a great student of the Depression, and in, I think it was his PhD thesis, going from memory,
yes.
but sometimes the balloon prevails. He says that they did not ease enough for long enough, right? So given where he was during the financial crisis, we eased a lot more, a lot longer. And so we gave birth to the concept of quantitative easing. And we had the iterations of quantitative easing. So that explains the divergence from the Gresham W to today's W. And then we started tightening, right? We had 9 interest rate hikes before the central bank backed off. Obviously, during the quantitative easing, they took their balance sheet from about $380 billion to $4.5 trillion. That's quite a remarkable increase. And so we see that these things have backed off, and now overlaying those charts, we look at, okay, so if we start tightening again, and we're more leveraged than we were before the global financial crisis, then is the probability significant that the second V will play? And my answer to that is yes. Now we take that backdrop, I take that backdrop about what's going on in the world. So you definitely have populism happening both on the left and the right side. Dalio has certainly done some fascinating historical research with regards to this, but the overriding concept is just that is simply created by the wealth gap. You go back to the fall of Rome, you can go back to the French Revolution, and what happens in this sort of business cycle environment is that as you go through many iterations of the business cycle, particularly a couple of credit events, you have the easing creates that bubble more than it ends up in the real economy. Just in the last year and a half have we seen actual wage growth in the bottom of the economy, and so there is a significant wealth gap, and wealth gaps historically breed populism. What populism? How do we define it? It's presidents and political leaders who, not always presidents, but political leaders who come to the forefront who are saying, hey, we've lost way in the world, and we have so much suffering going on, and we're going to return to how it was before. And that is attendant with protectionism, nationalism, infrastructure spending, military spending, and so that's sort of the template. And we start to see that playing out. And I will note the difference between populism on the left and the right is that you get sort of the top of the V, and you have this very over-leveraged situation where monetary policy becomes a bit less effective, as it did in 1937. You have a system where people on the left say there's going to be shortages. We have to make sure that we have the proper social programs in place to help people. There's going to be shortages. That's a benevolent concept, right? Then you go to the right, and I pride myself in being fairly apolitical. I like numbers more than I like political ideology. You go over to the right and you say, we're going to fall off a cliff. Let's stop the spending, because if we fall off the cliff, there's going to be shortages. So they have another very benevolent concept, right? But there are two different approaches. As the leverage and as the political uncertainty gets more extreme, you have the left and the right go into further and further extremes of their ideologies of how to handle this situation. And right now what you're seeing is you're seeing protectionist and nationalist kind of ideology, a lot of confidence in capitalism and capital. And on the left, you see, okay, let's head over in the socialism direction because capitalism has failed us. And that has played out many times in history, and that's the current environment. So then I say, okay, so what's happening in the current environment? And I go back to my charts, look at the S&P 500, which has gone parabolic in the last 4 or 5 weeks. And I just see a lot of correlation between the historical events.
And what I'd like to do, though, is bring you back to, or talk about one of the tributaries, one could say, of populism, and I think that's trade. So how does trade affect how you look at investing right now? I mean, do you think that we're going in a protectionist or globalist direction at this point in time? And how does that, I suppose from there we'll ask, how does that affect your outlook on markets and the economy overall?
Yeah, perfect. And I'll talk a little bit, too, about what we look at with our portfolios. But the thing, I believe we're going in a protectionist direction. We've been going in a globalist direction for about the past decade. Protectionism and globalism are different. They're just different cars. It's like comparing a Corvette to a Porsche, right? They're both really fast cars, but it's different ideology that supports the economic growth or theories behind economic growth embedded in those two things. But it's really hard to try and take a Corvette and a Porsche and do half of a Corvette engine and half of a Porsche engine and expect the system to run really well. And that's sort of what we have right now. Unintended consequences, and, there are faults in both engines. And, with globalism, the problem that you see occur as it progresses is that if you take two names, right, and we're just going to be very general and use very round numbers for the sake of example, and you have one, these nations originally are 50% agricultural or 50% industrial, right? And you decide that you're going to have these two nations trade under the, ominous sort of thing of cost pressure, right? We always have cost pressures in a debt-based monetary system. What happens is it's sort of an Adam Smith thing kind of takes place, right? And you kind of build this assembly line between these two nations, and you have this efficiency that occurs. What happens is that one, and I'm very extreme for the sake of example, one nation becomes, let's say, 90% agricultural and 10% industrial. The other nation becomes 90% industrial and 10% agricultural, right? Because you're combining the forces of these two nations. The problem is that the populace that participated in the minority stake in each nation prior to this amalgamation, they don't usually switch continents. They don't usually move. If you're an agriculturalist where agriculture is declining, you don't usually move to another continent to be more relevant. And so that displaces a portion of the population. That's the unintended consequence of globalism. And so what happens? You have a populist movement that brings back in protectionism to say, hey, guys, all of you guys that lost your jobs, this date of globalism, we're going to give you your jobs back. And they start to try and reverse those mechanics. And that's the natural sort of rubber band effect of overcorrection.
So you're alluding to there is the unintended consequences of specialization, right? So as Smith forecast in his Wealth of Nations, countries tend to favor the factors of production that they have in greatest abundance and that they make the most money at. So I suppose here in the United States, one of the rubs on global trade has been that one of the factors that we don't have in abundance is labor. China, Mexico, Vietnam, et cetera, have them or have labor in abundance. So labor-based production is by those markets. So
let's bring that. Yes, let's bring that back to where we are in the context of asset management, right? So we see this sort of chaos playing out. We look historically, and you get a larger and larger divergence between the left and the right. And you're over-levered in the context of this political divergence. And, yeah, historically what happens is you have a massive recession, right? Because you have all of these factors fighting one another. You're over-levered. The money supply, is not substantiating the lower half of the economy, certainly. And you get a massive sell-off. So we bring that back to our chart model, and we go, wow, it looks like a pretty good narrative that we're at the top of the V from the credit crisis in 2008, even though we've been in a record bull run since 2009. And what do you do with your portfolio? I want to just kind of, one of these about globalism, which is interesting, is that, we have sort of the, Harry Markowitz obviously won the Nobel Prize in 1951 and talked about, diversification and sort of the old adage in America is stocks and bonds, right? So in the financial crisis in 2008, the S&P 500 lost 38% and long-term bonds gained 38%, right? So you had this sort of, buoyancy inside the portfolios. But right now, what's super interesting is as we've become more global, have many assets in the United States up simultaneously, right? We have long-term bonds that have been up for quite a while. We have, that is very strong. The S&P 500 made a new record yesterday. Also gold, which is one of the sort of safe haven assets, classically, is up, right? So what that tells me is that a lot of assets are coming into the U.S. We have all of these assets inflated simultaneously. There's a lot of assets being played in the U.S. And then I look at, well, could that be? Well, for me, it's very simple. The rest of the world, much of the rest of the world has negative interest rates. And so then start looking at why do they have negative interest rates? And if people are leaving assets, capital is leaving those countries to chase our positive yield, even though it's not very positive, it's positive, and there's positive yields in the UK, of course. How sustainable is that, right? Are we going to continue to have positive yields in the face of their negative yields for a long time? Are we going negative? Are they ever going positive? You look at, some of the causation behind capital flows in this era, I think that's something to really look at, that, I don't know that being defensive inside the USA is going to be as effective this time around because of this globalization as being defensive, elsewhere if we happen to go to negative yield. And and we can talk about how that happens.
Well, Ed, let's hear.
Okay, so why would any sovereign nation ever have negative yields, right? Why would anybody ever have any negative yields? And the simple answer to that is because negative yields are, better than default. And default, if you look at just statistically the percentage of losses versus negative yields, it's drastic, right? So you look at the only thing that negative yields is supposed to save and be any kind of positivity is in the face of default. So you look at the United States. We were out in the 80% to GDP in 2008 as far as debt to GDP. We're now over 120% debt to GDP in the United States, right? So we look at these things. We're looking at fiscal spending and fiscal policy to now work in tandem with monetary policy and support monetary policy. Monetary policy has become a little bit less effective, right? Because of basically the amount of money floating around. You add more money to already a pile of money and you don't get the same easing effects if you add money to a shortage of money, right? Because you're just not creating that much of an effect. And so you look at all of that, and you know that the debts and deficits are, scheduled to hire whomever gets into office in 2020. And so you kind of look at that, and I think I could make a fair case for the fact that, number one, in every recession, let's just go back to 2000. In 2000, the Fed lowered by 5% or 500 basis points. In 2008, the Fed lowered by 5% or 500 basis points and did quantitative easing. So we have fully exacerbated the balance sheet. And, we don't have that many bullets in the gun, right? From we started easing, we only had...
We're pushing it a string, would you say?
Yeah, exactly. The term, of course, coined from 1937, which correlates with my theory that we are at the top of the first V in the W. And that's the thing, is we are pushing on a string. The central banks realize this. It is hidden in their narrative. And so they are actually talking about counting on fiscal policy to help keep our markets liquid. Now, the other thing to kind of point out is that...
And Francis, if I may just interject for a moment and ask this question. A couple of years ago, a handful of years ago, I heard news that in some countries, they talk of confiscating bank deposits. And although it wasn't said quite way, that was the effect of the action of certain central banks. Can you comment on that? Is there any likelihood that we might see that trend spill over into developed markets?
Well, I actually could. I don't have it in front of me. I apologize, but there was some legislation after the financial crisis that was changed. There was a directive that was the FDIC and the Bank of England together that basically talked about, eventually, I haven't read it in a little while, I have to acknowledge to you, but basically talked about, and they were looking at, like, what happens if an extreme credit crisis happens again. And basically what they were trying to do was give, if we had shortages and bank failures, which of course we had many in 2007, 2008, and of course the FDIC works off of a credit line from Treasury. So, you sort of have all these, you have this contagion occurring. They would actually give depositors shares in the failing institutions. In September of 2017, I think it's called the final rule. Anyway, I don't have these things in front of me, but the Fed came and passed another piece of sort of legislation saying that basically there was a one-day stay should any of these banks file bankruptcy to move assets off of their balance sheet onto a liquid balance sheet from another bank. So what happens there is you sort of have a little bit of risk, and again, I'm prepared to go through the specific mechanics of it right on this call, but you have a little bit of risk of, hey, if you're going to get shares in your institution, but they have an ability to sort of take assets off of their balance sheet in order to put it on a more liquid balance sheet, you could kind of make an argument that depositors could sort of get the short end of the stick on that one. So,
I thought in this country that was one of the reasons why banks access to the Fed window, liquidity crunch. The reserve would be the lender of last resort, and it would enable the Federal Reserve to access the facility for the purpose of maintaining liquidity.
And certainly we have seen that recently in the repo market situation, where we suddenly quite aggressively started adding assets back to the balance sheet. Yeah, so basically how the system works is that, if there are no purchasers for debt, then the Fed steps in, right? And they become the purchaser of assets, right? Because if there's demand in the rest of the market, then, you can sell all the bonds that you want. And if nobody buys them, it doesn't do much good. So the steps in and does that. So that's what the Fed did in the financial crisis, and that's how they buoyed the banks and then had the bailouts, which kind of kept more banks from failing, or the globally significant financial institutions from failing. This legislation's been passed in the interim, and it is of the dire circumstance, and obviously that is designed to kind of come in and intervene, and they have done that very recently. Repo market, it's kind of interesting to me that they're not calling it quantitative easing, because mechanically, just to give a high-level breakdown of the Fed monetary policy, mechanically, all the Fed does is step on the gas or step on the brakes. That's it. Every single tool of monetary policy is a way of accelerating or decelerating the money supply. And I don't care if you get into the minutia of the repo agreements and the, repurchase and all of these different things. They're just these little levers that either put on the accelerator or put on the brakes. And when you really think about that, when you're driving a car, which most of us understand, you don't always have your throttle to the floor, right? You have a little bit of acceleration. You don't always slam on your brakes and push them to the floor, right? So the Fed is just driving this car down the road, and, they're adjusting. A little acceleration, a little bit of brakes, a little bit of acceleration. And right now, we've entered the reacceleration phase. But what was kind of significant about that is that when they started reducing the balance sheet, they started reducing the balance sheet a little less, but they got into a pattern of reducing the balance sheet at $50 billion a month. It had this little repo situation that accelerating the balance sheet at $60 billion a month. So for them to call it quantitative easing, it's like, well, again, let's not listen to the rhetoric. Let's look at the numbers.
So let me ask you something else, just to follow up on your comments about the repo market. the bond market provides liquidity to the institutional community, right? There are entities that are long cash and seek a greater return than depositing in a bank. And of course, there are need cash in the short term, right? Most of these agreements, I believe, are term. But what undergirds this whole system, I believe, and tell me if I'm wrong, is the privilege that is conferred on holders of dollars, U.S. dollars. U.S. dollar is the reserve currency of the world. And people have this sense that they can readily liquidate dollars, whereas if you were holding currency of Cyprus or Paraguay, it would be a little more difficult. So, to what extent is at all do you think reserve currency involved with this makes it possible for us to liquidity of the marketplace, to print money, to engage in activities like quantitative easing?
So first of all, well, there's more confidence, obviously, in the reserve currency. There's more confidence in the U.S. And right now, if you look at it, the U.S. economy is doing better than most of the world. And also, we have positive yield. So those are all things that sort of confirm that theory. And it is what it is until it isn't. I think that, that we're going to completely lose confidence in the U.S. dollar. But I will tell you, one of the ways that we sort of exploited this dollar, this dollar rise in our portfolios is when we looked at our emerging market debt. You can obviously via the ETFs, right? You can buy anything now. ETFs, you can buy, emerging market currency debt in local currencies, or you can buy emerging market debt in U.S. dollars. Well, if you look at the two charts over the last several quarters, there's a big divergence in that, and we switched from emerging markets in local currencies to emerging markets in U.S. dollars. That all being said, I think we're going to see is rather than, oh my God, all the banking institutions are fail, or oh my God, this, this liquidity provider of the Fed isn't going to be able, or oh my God, confidence is going to be lost in the U.S. dollar. I think what we're going to see is a rotation out of the bubbled asset prices in the U.S. into other parts of the world that are cheaper. And the simplicity of that is, once you get to a certain point, certainly the exacerbated example is a blow off top. Once you get to a certain point where assets are bubbled enough, the rate of return, the rate of acceleration, the rate of it continuing higher starts to diminish. And so you're going to, we look at returns going forward, they don't look as strong as returns that we've had. Certainly the S&P is up 24% this year. So then you're going to, investors, allocators, all of these people are going to look for return elsewhere. And then, of course, the old click is you go into these cheaper markets. And, if you see a reacceleration out of Europe or a reacceleration of China, to note that they are way ahead of us on the curve of easing. First of all, their business cycle peaked in the third quarter of 2017. So their business cycle is in a different place than ours. The business cycle, a recession is basically the peak of the business cycle to the trough of the business cycle. And their peak started in the third quarter of 2017. So nature, they're going to hit their trough and reaccelerate. They're going to have lower comparisons in earnings and things like that. They're going to accelerate sooner than we are. Well, investors in the U.S. are going to try to rotate into that reacceleration as the U.S. decelerates. We had a peak in earnings growth in the third quarter of 2018, and we've been decelerating ever since. Now, what's really interesting is that usually you have a deceleration in this growth before that deceleration starts, sort of on the back of that roller coaster ride. And usually the index of the S&P 500 will make a new all-time high in the face of that deceleration and fall. So that's exactly what happened in October of 2007, which was one in advance of when they actually officially, called a recession in 2008. When I go, okay, all right, have the yield estimates are inflated, we're at the top of the annual V, we're starting to see crack in the foundation with the repo market.
Frances, you're breaking up a little bit, so if you could move back
Sorry.
to wherever you were before. Thank you.
Okay, sorry about that. How am I now? Is that better? Okay, great.
Yes.
So you start to sort of see these rivers converge, right? You sort of have
Yes.
peak earnings growth. You have, blow off top looking conditions in the S&P 500. You have, a potential re-acceleration in other parts of the world. You have cracks in the foundation, the repo market, liquidity. You have the historic backdrop of populism. You sort of have this top of V scenario where at the top of the V, you had a tightening by the Federal Reserve, which is exactly what you had in 1937 was actually a tightening. You had an easing when it bottomed out in 32, and then you had tightening in 1907. And you just start to see the converging, whether you're a person or you're a historian or, you're a short-term trader, the picture starts to come into focus. And I would say that we have a very high probability that the United States going forward is not going to see the return that we've seen certainly this year.
Let's change topic slightly. Let's talk about the extent to which news headlines have impact on the business cycle.
Yeah, so you kind of have, so this is sort of interesting. You kind of have, right now, what we're seeing is you have super bulls and super bears. And the problem is that the super bears come out with all their warnings. Hey, what happened here? And oh, look at this and look at that. And the super bulls come out and say, all right, the S&P, there's more bad news than you can ever imagine, and the S&P is thriving, and therefore it's going to go higher. And that tends to be sort of the environment of a blow-off top. And bears are wrong, and they're doomsayers, and they're humiliated until they're right. And then what happens is, the cycle rolls over. So I kind of think that when I look at headlines, certainly from this, I just want to know, are they stepping on the gas or are they stepping on the brakes? And since when the minutes come out today, actually, in 90 minutes, there's more divergence than there has been in a long time between the FOMC, committee members. And I think sort of an indication that we're about to have a paradigm shift. And there is a lot of talk about, okay, well, we've inflated this balance sheet. We tried to reduce it, right? We were forced into reinflating it at a rate probably we didn't really expect to have to do that with. They're very careful with their narrative because I don't think they want to frighten anybody. But the truth is that they're inflating it, at a pretty large rate. There's probably some divergence internally, like, hey, but inflation's muted, so we go ahead and create the 2% inflation objective, or hey, do we go ahead and cover up the credit cracks? And I think that's what's kind of happening, and I think that's what has some members that want to continue tightening and some members that want to continue easing. I think if you continue tightening, you do risk a credit in some of the overloaded areas, which are subprime auto, student loans, corporate debt, most namely corporate debt. So that's the thing. And rolling forward, that's the management, right? Is you have a record amount of leverage.
You're a big fan of charts, obviously, and you have these charts. When they're going to be able to raise rates?
I don't think we're going to be able to raise rates for a while. I'll tell you, just looking at the charts, what's really interesting is that if you take the 2007 highs in the S&P and the Dow, we've basically doubled those highs. So that's going to be a significant place of resistance. On the NASDAQ, because interestingly, the NASDAQ in 2007 did not make a new all-time high. It did not take out the 2000 high from the tech bubble. We've tripled on the NASDAQ. So if you look at how extended these charts are, maybe tech bubble 2.0. I mean, we've certainly had tech taking these markets higher. And that's just sort of the charting perspective. As far as the perspective and tightening, I think there's too much leverage in the system to really safely tighten without risking a credit event. So right now we're just sort of hanging in there. Households are servicing their debt. Corporations are servicing their debt. But if you see any problems with debt service, you start to have more of a deflationary risk than an inflationary risk. And in that scenario, it would be quite a while before you could tighten.
interesting. So let's move on here and talk a little bit about the business cycle and recovery. Where are we in that? Because by the way, I also suppose this picks up on your last comment about raising rates. We can't pick rate rise until we see solid evidence of a real recovery. What do you say on that?
The thing is we've been in quote unquote a recovery, as far
but
as.
How real, Francis, how real has that recovery been? I mean, the market's up, but low GDP growth. GDP growth.
Yeah, let's talk about. Yeah, it's very low. Let's talk about that. Why? Okay, so number one, why have we pumped the system so full of money and we don't see inflation? It's just an indication of how severe the financial crisis was. And my argument about this is that most of the new liquidity that is created is having to service the debt because of the record amounts of debt, and it's not having the quote-unquote trickle-down effect. That's what sort of happened in the global financial crisis. Much of the new money that was quickly created on the balance sheet and the easing got sucked into debt service and sort of went into asset bubbles and that area and didn't have this trickle-down effect because, you saw the real economy really not recovering. So now you're sort of looking at that quintessential wealth gap that this sort of scenario creates historically. Again, Ray Dalio has done some great research about this, but he splits the upper 40% of the economy versus the lower 60%. And I don't know why he splits it there and not 50-50, but imagine because the diverging curves are a little more exacerbated. So as the upper 40%, there is inflation. It's in asset bubbles, and they're doing fantastic. In the lower 40%, because much of that cash or new debt coming in to cover the old debt and do the debt servicing just didn't trickle down. We've only seen in the last year and a half where we've seen an uptick in wage growth. And the problem is that,
Francis, isn't that part of the rub here with populism? That
absolutely. But I'll tell you mechanically how that plays out is you have massively extending earnings multiples, and you finally get this wealth ticking into the lower echelon of the economy where you see this uptick in wages. And what does an uptick in wages do? It loses those profit margins. So you have this uptick in wages, you have an uptick in consumerism, you have consumers going to buy things, but at the same time you're putting pressure on those profit margins in an era where earnings multiples, obviously they peaked in the third quarter of 2018, are super extended. And just some friction there, and the timing probably things will not well for asset prices. In fact, those profit margins squeezing in the earnings recession will probably take over before, the end of the economy has too much, these things trickle through the system very slowly. Probably going to have an earnings recession because you'll probably see the pressure on earnings prices before you actually see, oh, wow, the lower echelon of the economy has more access to healthcare, better education, and all these things that they don't have that the upper 40 percentile of the economy has.
So you mentioned the word bubble, and when I saw you at the British consulate speak, you talked extensively about the bubble, or your view that we're heading toward a bubble, which is what we've seen historically, right? I mean, that tends to be the trend. Where are we in all of that? I think the audience might be interested to hear your view on where we are with respect to the bubble market.
Yeah, I think we're in a bubble, particularly in the U.S. I think that, we see yesterday, new all-time highs on all of the indices for equities, and not all of the indices, but the major indices. And we see a bubble in the bond market. I mean, if you thought it, the bond market has been up now, since September of 18, and the bond market is so far up that if you see any kind of an uptick in rates, which I'm not necessarily predicting, but if you saw any kind of uptick in rates or inflation, you're going to have bond market risk like crazy, right? Because you've paid so much premium on those values. So we're in a bubble in the United States, and the bubble has been further exacerbated and further blown up by the fact that I think a lot of foreign capital has come over here to find positive yields.
And else that you said at the British consulate when you spoke was that right before they pop, they go hyperbolic, right? They go.
Yes.
So so when do you see it going vertical, or what does the chart tell you? What does it tell you about?
This is me reading tea leaves amongst friends.
Yes.
Because there are a lot of
we won't tell anyone. You said it. Go ahead.
Right. Me reading tea leaves amongst friends. I mean, I watch this every day. Right? Like, I'm not going to make a statement that says, "Oh, we're done," in U.S. equity markets, and watching these things, second by second. But I remember at the British consulate, answer to your question about this was, I think that the China trade is the blow off top. I think that the trade is so priced into the market. I think nobody wants to be short ahead of an announcement by China trade. So I think you see a lot of muted volatility on the VIX index, which we're still sort of hovering around the 1250, 1260, which is pretty low on the VIX index. But nobody really wants to be short. So I think what you're seeing is that the market's paying more attention to the headlines on China trade than the market is paying attention to the decelerating economic data, which is mixed. You had housing starts go back up again. The economic data is mixed, but it's decelerating. Growth and inflation are decelerating. So I think that the market's more pricing in the China trade than it is that. With Brexit and with the China trade, once you get a certain outcome, whether it's a hard Brexit or a deal, or yes China or no China on the trade deal, I think you're going to see the markets react. Personally, even if we get a China trade deal, I think that is so priced into the market right now that we could even sell that good news because it's over. The headline risk is out, and the volatility index, I think, will return to looking at the decelerating growth and inflation in the market. So I think that potentially, if you just look at the pattern, the market has gone straight up for the last 4 or 5 weeks. And I think, quite honestly, this could be our blow-off top. And I think that even if Trump says, all right, I've got a deal, obviously the market is going to try to very quickly put in sort of the particulars about that deal because they've been very quiet about that because I think he learned that he puts his thoughts on Twitter. It causes some volatility. I just think that we could sell good news because so much of that has been pricing.
But Francis, if that's the case, right, when will it have gone hyperbolic? It hasn't gone hyperbolic yet, right?
I mean,
it's been over the last 10 years, but what?
If you look at the chart angle of it, really has accelerated on that angle basis. So, when I was hyperbolic, first of all, as a technical tenant, whatever angle the market goes up on, the old tenet is that it sells at double the angle, right? So if you have something going straight up, you're going to have something, going straight down. Whereas if you have something kind of crawling up at 11.5 degrees or something like that, that's more sustainable trajectory. And I just use the analogy, if you're pushing a wheelbarrow full of rocks at an 11.5 degree grade versus, putting it up straight up a hill, you're going to get a lot more energy or fuel in that market in order to continue pushing it up a hill. And if you look at volumes and things like that, they've decelerated quite tremendously. To get that fuel from somewhere, and that's what happens. And so because the markets have really just gone up in a straight line at such a severe angle in the last month, that could be part of that sort of hyperbolic, scenario, basically.
Yes. But Francis, our time is coming to a close shortly, and I've noticed that we don't have your contact information up on the screen. And so if you're there, can you please put Francis's contact information up on the screen? We'd really appreciate that. Thanks so much.
Yes, and I can, Danny, I know I've done a very high-level overview of some of these concepts, and I just wanted to kind of relate the historical perspective to what's happened now. And I wanted to relate the political headlines to the charts, to the Fed, to all of these different things that people watch and feel are very separate, they do kind of fall into a pattern. But definitely, if somebody wants to get into the minutia, we hit numbers very specifically. We manage these portfolios actively within the context of this. If somebody wants to get into the minutia of some of these numbers against the backdrop of the overview that I've given today, please don't hesitate to contact me. I would love to talk to you about that.
Yes, and Frances, I think you've done a very compelling job, very insightful into what's going on. I think you've tied a lot of loose ends together. So I do want to thank you for that, and I want to encourage everyone. I want to echo what Frances said. If you have any questions or comments, first of all, you can share them here with us down at the bottom of the chat screen. Secondly, you can go one-on-one with Frances. Again, she's got her email as well as her telephone contact information. So, Frances, in the remaining time that we have here, I'd like to get your closing thoughts on. And in fact, you mentioned Ray Dalio several times, and I was just curious to see what, if any, notes where you and, say, Mr. Dalio agree or disagree. Do you want to spend a few moments talking about that?
What I really find intriguing about Mr. Dalio, obviously he's a very successful investor. I think recently he had an interview where he said, I've made money 18 out of the last 18 years. Not sure why it's out of the last 19 years, but that's obviously, some amazing statistic. The thing is that what I really like about the way he thinks is he looks at super long-term historical cycles, and that's sort of what I endeavored to do. And I like to, take really historical notions against what's happening today. So, for instance, long before I ever even heard of Ray Dalio, but the amount of time between the two W crises up until the Great Depression was 156 years. And interestingly, it was 78 years between the Great Depression and the global financial crisis. So if you just do math in your head, that's exactly half of the time. So it's just really interesting to see that these mechanics are the same, and then look in present time with the current money supply, which is obviously huge, and just the rate of acceleration and deceleration in playing out what just basically hasn't changed, and which is the economic machine. The only thing that Ray Dalio says, the only point of slight disagreement, and I've never had a conversation with him about this, is he talks about the quote-unquote beautiful deleveraging in his economic machine. He doesn't really display the W phenomenon, but he does talk about that in his paradigm shift papers and things like that. So I think he is kind of thinking with that structure. But that's the structure of the monetary environment until it isn't. And when you can see that structure comes through these business cycles for literally hundreds of years, it's sort of somewhat rearing in the face of volatile headlines.
Yeah, and Frances, I do have a question from the audience here that I'd like to share with you and your thoughts on, of course. And run something like this. You talked about the market top, the market blow off. In a market blow off, what sectors do you like? Please contact me, and I can get into a very detailed discussion about this. But what I'll quickly say is that obviously, we look at some of the defensive sectors, and I do think that in the coming months that REITs and utilities, consumer staples, are probably going to do very well. You're breaking up. Go. Oh. I'm sorry. Just the most important time you broke up on us. No, that's that. So I think some of the, quintessentially defensive sectors, consumer staples, utilities, REITs, healthcare, that sort of stuff is going to do well probably in the next few months if market volatility increases. But on an overriding sense, I do think most of the U.S. is in a decent-sized bubble. And with the exception of the super safe haven assets, I do think that we're going to see a large rotation internationally. So when I look at a defensive perspective from a portfolio basis, I look at maybe rolling into a tiny uptick of inflation. Maybe we're rolling into, commodities have kind of upticked and things like that.
and kind of, REITs and utilities, and they're hugely up this year, obviously. And then we see a little bit more sort of relation back into those. They pulled back recently, and people are kind of coming back into them. To looking at what you're going to do in a deceleration model, obviously that goes to, overweighting fixed income and underweighting equities, and certainly, looking at data and problem with, sort of having a market tunnel with correlations go to 1. So with the exception of the extreme safe haven assets. So, but really call me and we can get into a big discussion, and I can talk about what I'm looking at internationally.
And Frances, before we say goodbye, I'd like you to just, for the benefit of the audience, talk a little bit about Optimal Capital and the services that you provide there.
So the whole endeavor of Optimal Capital is to kind of bring very exclusive hedge funds, type management, active in some scenarios, to retail. And so, for instance, we have our family office, a multifamily office. It's mostly people with significant liquidity events who don't quite qualify for having a singular family office. And we do direct private equity. We do a lot of alternatives as juxtaposed to some of the more quintessential retail models, which are stocks and bonds. But what we really do is we offer these portfolios. Our portfolios were studied in an institutional study at Goldman Sachs. We came out in the top 7% as far as institutional portfolios. So we take endowment-style investing to the retail market. And what's interesting about that is many sort of investors all over the country in the retail space don't really have a lot of analysis, and they don't really have a lot of sophisticated hedge fund type analysis because you have to pay for that. And so we sort of construct portfolios, kind of, implement as outsourced CIOs into those, retail markets. And so we do a lot of really sophisticated research. And, like successful hedge funds, obviously, when you say hedge fund, there are some that do well and some that don't. We lost significantly less than an 08 type scenario because we apply this very disciplined endowment model to people, and I analyze the equities in our portfolio. And so it's kind of the unique thing we do at Optimal.
Well, that sounds good. And so Frances and Stacy of Optimal Capital, on behalf of the New York Alternative Investment Roundtable, I want to thank you for spending time with us and sharing your insights and expertise regarding the market. We look forward to visiting with you again in the near future. And I would encourage everyone in the audience to take Frances up on her offer to contact her to talk about anything that she discussed and beyond. So, Frances, thank you so much, and folks, have a wonderful day, and until next month. Okay, so everyone have a good day, and Frances, again, thank you.
Thanks, my pleasure.